Good afternoon, this is Sean Golding with Golding & Golding, here to discuss an introduction to offshore tax compliance and IRS international reporting. It sounds scarier than it really is. When people think of offshore tax compliance and international reporting, they imagine some individual with, I don't know, like 30 different corporations around the world, all tons of unreported income and accounts and just shuffling money from one country to the next. It's not always like that. It could literally be as simple as you came to the U.S., you're a lawful permanent resident, you had a bank account with $200,000 in it, you had it forever. Now that you're here, nobody told you had to do anything about it, and now you have to go back and file for a few years and get into compliance. That's also offshore tax compliance and international reporting. So let's go through some of the basics and why it's important. Over the past 10 years or so, the IRS has really increased enforcement of foreign account and asset compliance. Forms you might hear about like FinCEN Form 114, otherwise known as the FBAR, it's been around since like 1970, but only in the past 10 years has it really gained traction, let's say, and the IRS has really started to increase enforcement. The FBAR is just one of many forms. In fact, the FBAR is not even a tax form, although the IRS is tasked with enforcement. There's FATCA, which is the Foreign Account Tax Compliance Act, and that's on Form 8938. People who have certain PFICs, like holding companies overseas, foreign mutual funds, those are reported on 8621. You received a gift from your sweet grandma that's more than $100,000. You got to report that, or else you can get dinged with a 25% penalty. You've been part of a family corporation for who knows how long. You moved to the U.S. No one ever told you had to report that. Depending on what category of filer you fall into, you may have several reporting requirements and schedules on Form 5471. For those of you who have cryptocurrency located overseas, there's proposed regulation, I think it's FinCEN Notice 2020-2, where they're going to, essentially you're going to have to report it the same way that you would have to report currency in an account. So let's go through some of the different common types of offshore compliance that you should be aware of. It basically breaks down into two types of categories. There's income and there's reporting. So from a baseline perspective, the U.S. follows a worldwide income model. That means if you're a U.S. person, which means U.S. citizen, lawful permanent resident, foreign national who meets a substantial presence test, you have to report your worldwide income on your U.S. tax return, unless, maybe you live outside the U.S. and you meet a treaty exception or closer connection for substantial presence. But for the most part, you're living in the U.S., let's say, or you otherwise qualify as a U.S. person, you don't meet an exception. Your investment income, many countries have accounts, France, a lot of the Asian countries, India, where if you are a resident of that country, then the income is exempt. Passive income, let's say, is exempt. It doesn't work that way in the U.S. For the most part, unless an exception, limitation, or exclusion applies. Even the exempt income from overseas is taxable on your U.S. return. Earned income, of course, is taxable. If you have foreign tax credits in any of the categories, you can apply them to try to reduce it. If you live outside of the U.S. as a U.S. person, you may qualify for the foreign earned income exclusion. Real estate income, a lot of countries, they have a baseline threshold that if you don't earn more than that, you don't have to report it. That's not true from a U.S. perspective. And even if it nets out a negative, you still have to report the income and the deductions on Schedule E. From a reporting standpoint, you have to report your foreign bank and financial accounts. You'll hear that phrase often when you look this tedious stuff up online. Bank accounts, investment accounts, savings accounts, fund accounts, CCOVs, mutual funds, etc. Those are all reportable. And even ancillary types of accounts like your foreign pension account, your superannuation, your CPF, your MPF, your EPF, your pillars 2 and 3. Those are typically reported on the FBAR Form 8938. And then life insurance policies that have a surrender value or cash value, those are typically reported as well. So what happens in the typical situation where Joe and Jane had no idea that they were supposed to do any of this, whether their new CPA, a friend, someone told them, hey, you're supposed to be reporting all this and you haven't done it. So here's a few traps to avoid. Quiet disclosure. That is the idea of just going in and saying, you know what, I'm just going to report all these accounts, submit it to the IRS, and hope that they don't find me. The problem with that is if you go that route and you submit, like a gang of forms for prior years and you get caught, the concern is if they think you knew that there were other options available, they could really ding you for some significant fines and penalties. Willfulness, those penalties can be brutal. They could also refer it for a criminal investigation. Now, criminal is very rare. It is. But if you get caught knowingly trying to avoid the proper reporting channels and income channels, it could become an issue. The same concept applies for filing forward. Oh, I just learned about it now. I've got all these prior years, but I'm not going to file those. Instead, I'm just going to start filing now forward. It's called filing forward. And that can also cause a problem too. Plenty of these forms, the 8938, for example, asks if you opened or closed the account this year. If you don't mark off yes, because you've had the account for many years or several years, well then, it just takes a quick audit or cross-reference or FATCA reporting from one of your foreign financial institutions to alert the IRS that this account's actually been open for a while. Why don't you go back and file the forms in prior years? If you're filing in the current year, then you know about the form. And please try to steer away from fear mongers. I can't tell you the number of people who call me and speak with us here and they say things like, oh, I spoke to this attorney, the CPA, they said I can automatically go to prison for 20 years. I'm going to lose my immigration status. They're just going to rip me away and take all my assets and surrender my assets. It does not work that way. A majority of the time, the person is non-willful. Even if they're willful, there's a program for people who are willful. It's called the Voluntary Disclosure Program, VDP, is used for offshore and domestic. You'll be fine most of the time, okay? If you're out of compliance for prior years, there's various offshore tax compliance and international reporting programs. VDP is for people who are willful or can't certify under penalty of perjury that they're non-willful. For people who are non-willful, there are many more programs available. There's the streamlined domestic offshore procedures, streamlined foreign offshore procedures. Both of those are part of the streamlined filing compliance procedures, people who are non-willful. There's reasonable cause and there's delinquency procedures. We have lots of free information available on our main website. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.